Right, let's connect with Anand Radhakrishnan, Head of Equity and Portfolio Manager with Franklin Temple Asset Management. Anand, good morning and thank you for joining us. Anand, what is your view on the earnings season so far? Because up until now, investors clearly have been handed over a mixed bag of earnings.
I think the kind of earnings that has been reported till now is fairly on dot. They have not been below expectation, and some companies have been able to deliver slightly better than expectation number. So Q3 of earnings seem to be at least pointing to some kind of improving or a bottoming out of margins for the corporate sector as a whole, and bottoming out of growth as well. We have not seen any incremental margin pressures develop during this quarter, going by the results that have come so far.
Anand, do you think the market is fairly priced at the index level at 13 to 14 times 1 year forward earnings? Where does the market go from here?
While in the near term, on the basis of near-term earnings, the market may look as if it is fairly priced. We do think that on a medium-term earnings basis, market is undervalued. The reason why we say that is the current margins of the entire corporate sector is fairly depressed. From a high 20-odd% of EBITDA margins, we have seen corporate sector margins come all the way to 13-14%. And given those low margins, where we see scope for expansion over a period of time, we think that earnings potential is pretty high. So based on where the earnings can go over a medium term, the market seems to be relatively undervalued at this point of time. On the basis of near-term earnings, it might look as if it is trading at 14 or 15 times earnings, which may look fair, but vis-a-vis its medium-term potential and the ability to bounce back from the low margins, we do think that the markets are undervalued. Another reason why we think the markets are undervalued is there is a leverage in the corporate balance sheet at this point of time, and eventually this leverage will come down once the interest rates drop and the growth rates pick up. And at that time, the positives of the deleveraging cycle will accrue to the shareholders and eventually into the earnings growth. And that, I think, is a big cycle that is waiting to come under favorable circumstances, and that gives us the confidence that the markets are relatively undervalued at this point of time.
Right. Anand, a very overwhelming feature for the Indian mutual fund industry has been the kind of redemptions they are witnessing on a daily basis. So what's the update there? Have the redemption pressures eased?
We haven't seen big redemptions in our funds over the last couple of months. Nevertheless, we haven't seen any inflows either. Redemptions do happen in trickle because every time the market moves up, we have seen some investors take the money off the table. And at this point of time, it does look like the investors' investment sentiments towards equities doesn't seem to be pretty good. So we haven't seen inflows into our funds at this point of time. But nevertheless, the outflows seem to have moderated in the last couple of months.
What's your market view, predicated on what kind of GDP growth and earnings growth will underline the direction of the market according to you?
If you really look at the market's earnings growth over the last 10 years, first 6 years we have had earnings growth in excess of 20-odd%. And we have seen less than 8% earnings growth in the last 4 years. I'm talking about compounded annual growth rate of 8%. So we have seen a phase of high earnings growth and then the phase of a very modest earnings growth. Now the question one needs to ask is, do the next 4 years, what are the likelihood that the market corporate earnings growth will be more like 8% or less than that? Or is it going to be more like 13, 14, 15%? Or can it be even 20% for that matter? Now we think that earnings go through a cycle, and currently we have gone through a very, very modest cycle of 8% earnings CAGR over the last 4 years. And this will reverse over the next 3-4 years, and we would see next 3-4 years earnings growth of upwards of 13-14%, which augurs well for the overall market as a whole. So that's the reason why we do tend to be a little more optimistic about the direction of the market despite all the macro headwinds which we seem to be having at this point of time, as well as the global uncertainties that keep coming up every now and then. It is based on corporate earnings growth, and corporate earnings does seem to have bottomed out, and it is looking to grow at a more nominal pace in the next 3-4 years.
Anand, we ask a lot of FIs that how do they tie in the political risk with the India strategy, and we've asked Dr. Mark Mobius this in the past as well. As domestic investor, what macro political risk are you navigating while managing your portfolios?
No, as a domestic long-only portfolio, I don't have the luxury of timing the market or deciding whether I like or do not like the market. We tend to understand the macro risk, but we don't try to take excessive view of it and try to factor it into the portfolios. Our portfolios are built on from a bottom-up basis. So the whole idea is to kind of identify companies, good quality, long-term winners which can compound your money at a consistent pace. And as long as these managements are able to traverse the macroeconomic environment, the political environment very well, we as investors are fairly safe. So the main job as portfolio managers which we do is to try to find companies, managements which are able to navigate the environment of a country, economic environment and the political environment of a country very well. We ourselves do not traverse that environment at our end. We let the companies where we invest in do that job for us.
So Anand, what happens to infrastructure, power, capital goods, metal story over the next 6 months? And when does allocation of money shift to those sectors in a meaningful manner rather than just to see, trading rallies trickling in?
We might see a revival in the infrastructure capital goods sector, definitely, for sure, because we do need a large infrastructure still to come online. But our view is a little more nuanced here. We think that our historic investments which the companies have made either on themselves or in a public-private partnership model, many of these investments are either yet to kind of fructify in terms of returns, or some of those projects are yet to get commissioned. So many of the corporates which are already made the investments are waiting to make money out of those investments, and so are the investors. So unless it is proven that the existing investments in the infrastructure space is yielding returns to the investors, it's very unfair to expect them to make further more investments in that space. Neither do they have large internal accruals to commit to investing more in the infrastructure space. So that is a problem which we have, and therefore we would like to see the fructification of the current infrastructure investments as a first step towards building a slightly more constructive view. Till the time we see momentum being built along those lines, we would like to maintain a cautious stance to that sector.
What is your expectations from RBI, because you have a reasonable exposure to banks? Would a rate cut now from Reserve Bank of India could cheer the banking sector, which otherwise is not in a great shape, so to speak?
On a lighter note, we've been waiting for inflation to come off for more than a year or so now, and it seemed to be a very elusive thing to chase, given the stickiness of inflation and how deeply embedded the inflationary expectations are. And also, given the recent turmoil in the emerging markets and the wobbling which we are seeing in the global markets, we would expect the central bank to take a cautious stance and would not like to take any aggressive step towards easing interest rates at this point of time. So I wouldn't be surprised if they hike the rates, which seem to be the consensus view at this point of time. But this should not be this should not be viewed as a structurally negative stance. These are, given the current circumstance of high inflation and the macroeconomic instability that we are seeing across emerging markets, it would be prudent to take a more conservative stance at this point of time.